Welcome to the Nichols Tax Update Podcast for November 9th, 2020. This program is produced to provide current information about developments in United States tax law, cases, rulings, IRS pronouncements, and expert comments on hot topics. You are receiving it as a member benefit from the South Carolina Association of CPAs. My commentary is necessarily brief, and you should consult appropriate authority before taking a position on any item discussed in the program. I acknowledge the value of my subscription to Tax Notes Today, a publication of tax analysts, the preeminent source of information for tax professionals in preparation of this program. Let's get started. What's in here this week? Well, we've got a private letter ruling on addressing the termination of an S election, which turns out to have been inadvertent. IRS offers a relief initiative giving option to struggling taxpayers in Information Release 2020-248, final regulations providing guidance on required minimum distribution calculations in final regulations. I got that backwards. The official, final bonus depreciation regulations provide further guidance. Would you believe it? They're not done yet. And then IRS guidance on the treatment of distributions after a plan terminates. That's in Revenue Ruling 2020-23. Finally, the IRS reminds eligible college students to register for economic impact payments in another Information Release 2020-250. Termination of an S election was inadvertent in the most common cases that we see. The IRS granted the taxpayer's request in Letter Ruling 2020-44003 to be treated as continuing to be an S corporation from the date their subchapter S election was inadvertently terminated when a trust became an ineligible shareholder. Now, careful. The trust became an ineligible shareholder. How did that happen? The trustee of an electing small business trust, which is an eligible shareholder, neglected to file the required election affirming the trust status. As long as you file the election, an electing small business trust is a permitted shareholder. One of the conditions that's imposed here, this is a quote from the ruling, as an adjustment under 1362F4, a payment of an undisclosed amount with a copy of this letter must be sent to, and then they give the address. So there's some extra money is going to flow from the S corporation back to the Internal Revenue Service as part of the consideration for allowing the corporation to maintain its S status. Then there is the fee to prepare the ruling request. Someone got paid to prepare it, and the user fee? No end to it. It would have been so much easier if the trustee had simply filed the election on time. Maybe someone's professional liability insurance paid for the private letter ruling. I'd like to think so. Next, an information release in which the IRS offers options to struggling taxpayers to pay or work out their tax debt. Seeking to help taxpayers affected by the COVID-19 pandemic, the IRS has announced the expansion of taxpayer options for making payments and alternatives to resolve balances owed. Among the highlights of the Taxpayer Relief Initiative are taxpayers who qualify for a short-term payment plan may now have up to 180 days to resolve their liabilities instead of 120 days. Then, the IRS is offering flexibility for some taxpayers who are temporarily unable to meet the payment terms of an accepted offer in compromise. If you worked and you struggled to get an offer in compromise accepted, and now, as a result of COVID-19, your client simply cannot make the payments, and so you're going to lose the benefit of the offer, the IRS says, wait a minute, we'll renegotiate the terms of your payments so that you do not lose the benefit of your offer in compromise. I think it's a wonderful gesture. It's a wonderful rule by the IRS to take into consideration that a lot of us have circumstances absolutely beyond our control, especially if we would lose the benefit of a hard-fought offer in compromise. Next, in this listing of initiatives. The IRS will automatically add certain new tax balances to existing installment agreements. If you're an individual or an out-of-business taxpayer, that particular taxpayer-friendly approach will occur instead of defaulting the agreement. That can really complicate matters for people that are really trying to pay their taxes. So you got a new tax balance. You couldn't pay the old one. You probably can't pay the new one either, but you are making regular payments on an installment agreement. The IRS will add the new balance to what you owe and you just keep making the same installment payments. To reduce the burden, certain qualified individual taxpayers who owe less than $250,000 may set up installment agreements without providing financial statement or substantiating their monthly payment, or substantiating their assets if their monthly payment is sufficient. I got tangled up on that one. Some individual taxpayers who only owe for the 2019 tax year and who owe less than $250,000 may qualify to set up an installment agreement without a notice of federal tax lien being filed. That's a real break. Otherwise, the IRS just automatically files a lien, and there goes what? There goes your credit rating, right? They want you to pay your taxes. You got to stay in business. They file the lien. They might even put you out of business. Additionally, wonderful word, the IRS uses it all the time. I would simply say in addition, but they like additionally. Qualified taxpayers with existing direct debit installment agreements may now be able to use the online payment agreement system to propose lower monthly payment amounts and change their payment due dates. You can go into the system and do this yourself. A great announcement by the IRS, very thoughtful. They don't want taxpayers to be in trouble. It doesn't do them any good. Final regs, providing guidance on required minimum distribution calculations. These final regulations provide guidance on the life expectancy and distribution period tables used to calculate required minimum distributions. And that's because we have new mortality tables. The mortality rates for 2022. So if you're in the middle of a planning project involving annuities or grantor retained trusts, you're going to be interested in the mortality tables. Changes to the rules for determining substantially equal periodic payments. Oh yeah, that would be for anyone who was taking an early distribution from their IRA, and those rules or the changes will be published when these regulations become effective. Final bonus depreciation regulations are providing further guidance. They do provide guidance on the additional first-year depreciation deduction under 168K because that was a retroactive change in the CARES Act, retroactively changing the Tax Cuts and Jobs Act provision, and they couldn't write that into the regulations until the law changed. Among other things, the final regulations provide changes to definitions in the 2019 final regs for qualified improvement property, predecessor, and class of property, and those changes are necessary to take into account the retroactive changes in the CARES Act. The regs also provide that for purposes of the qualified improvement property definition, the improvement must be made by the taxpayer, not by someone else. The IRS gives us guidance on the treatment of distributions after a qualified plan terminates. The IRS, this guidance, Revenue Ruling 2020-23, deals with retirement plans that are funded through individual or even group Section 403(b)(7) custodial accounts. If the plan is terminated and the plan distributes individual custodial accounts, that does not count. The distribution is not included in your income until you take money out of the custodial account that was distributed to you. So the plan terminates, the terminated plan distributes individual custodial accounts. Normally that would be a taxable distribution, but Revenue Ruling 2020-23 says it is not. You will not have a taxable distribution until you take money individually out of that custodial plan that was distributed to you in connection with the termination of an employer's plan. Finally, you're a college student, you work in the summer, you make enough money to kind of help support yourself, but you don't make so much money that you have to file a tax return, and you were able to convince your employer not to withhold any federal income tax because you weren't going to have a liability, and you're not going to be counted as a dependent on your parents' return, you don't file a return. If you don't file a return, you won't get an economic stimulus payment. So self-supporting college students who are not required to file a tax return can still qualify for an economic impact payment, but you must register by November 21st. It's just a couple of weeks, less than 2 weeks away. Income below filing threshold, no need to file to recover income tax withheld. We get that, but you need to file a return anyway. You may be supporting yourself with Section 117 non-taxable scholarships and fellowships. Still, you're able to live, but you don't have any taxable income. You may not even have a Form 1099. So the IRS has no idea where to find you to give you your economic stimulus payment. File a return. Well, time goes fast, right? Our 10 minutes, a little more than that for the week. Thank you so much for your continuing support of this little short snippet. And as always, stay safe.